Hi, my name is Rusty Vanneman. I'm the Chief Investment Officer at Orion Advisor Solutions. It's nice to be here today at the AdvisorTech Virtual Summit. At Orion Advisor Solutions, our mission is to power the advisor-client journey through our process of prospect, plan, invest, and achieve. As for our background at Orion, our roots do go back to the late 1980s. We are headquartered in Omaha, Nebraska. We do have offices also in the Philadelphia area, in the Cincinnati area, New York, and Seattle. We currently work with over 10,000 financial advisors, over 2,100 advisory firms. Our assets under management at last count were $44 billion, and our assets under administration are $1.3 trillion. As for my own background, I've been in the industry for 30 years. I've spent the last 8 years here at Orion. I have been at places such as Fidelity Investments and also E-Trade, and I also spent a dozen years as a managing director at a large registered investment advisor in the Boston area. Well, I have 10 minutes and hopefully less to talk about, which I think are three big things to talk about in this environment, regardless of who has won the election. And the first of all, it is the election itself. And I think a lot of people have seen the basic analysis that it doesn't matter too much what the political party of the winning candidate is, the presidential election. The market tends to generate positive returns regardless. And that's also regardless of who also has control of Congress. What I think the most important takeaway is don't panic. And again, in 30 years, I have seen many investors panic and go to cash because they didn't like President Clinton, or when President Bush got elected, they went to cash, or when President Obama was elected, and of course, when President Trump was elected, some people went to the sidelines as well. Quite frankly, if you only invested during times when the president was a Democrat, you made money. The same thing about being a Republican, but you made a heck of a lot more if you just stayed invested throughout. Now, also, there's a lot of analysis on which sectors do best depending on who wins the election. I have to admit, just think about some of these studies. For example, President Trump is supposedly great for the energy sector and great for the financial sector, but you can see what their share prices have done in recent years. The energy sector has been plummeting. It's less than now 2% of the S&P. Meanwhile, you would not expect clean energy and the technology sector to perform as well as they have. I think one area, though, that basically has bipartisan support, sort of implicitly, is that value stocks probably will outperform growth stocks moving forward. And obviously, there's a lot of reasons for it, but one of the reasons that I think is, of course, the antitrust regulation talks that are going on right now. It basically has bipartisan support, arguably more from the Democratic Party at this point, but that could be a catalyst for relative underperformance from the big tech names, which, quite frankly, we've already been seeing since midsummer. You use this as a backdrop of kind of the elite 8 names in the big tech space. They've had huge gains this year. Granted, they've had year-over-year growth, both top line and bottom line, but those price gains have far, far exceeded even the fundamental improvement. So you've got technical weakness, you've got overvaluation, you have the catalyst of antitrust regulation, and then there is also the chance that cap gains could go up as well next year. And what you could see in the fourth quarter is something called tax gain harvesting. Again, investors looking to take gains at lower cap gains rate. Obviously, that impacts winning stocks more than losing stocks. Again, that would be another catalyst for underperformance from technology, from growth stocks in general. Bottom line, diversify into value stocks as well. The second big thing, I think, again, sort of implicitly bipartisan support, is expect higher inflation. This is something we really haven't worried about in years, but federal spending is higher regardless of the party. Modern monetary theory basically has been sort of adopted by both parties. Just to give this a frame of reference, federal spending as divided by GDP, so the size of our economy, has been basically 18 to 22% going back to World War II. Since 2010, that number has really ratcheted up to basically 20 to 25%. Well, at the end of June this past summer, that number was closer to 50%. And granted, while stimulus still hasn't been passed as of this recording, the timing and details still have to be sorted out. I expect that it will. And it's $2 trillion, give or take. Again, is another 10% for the size of the economy. That's just a lot of fiscal spending in the system. Generally speaking, that kind of federal spending is good for the stock market. It's good for corporate earnings, as it's good for nominal growth. It also tends to be inflationary on the margin as well. I think in addition to that, we have to recall, of course, there's incredible monetary support as well. in terms of just liquidity supplied in the system by central banks around the world, the fact that short-term interest rates are basically pinned at zero, meaning that real interest rates, at least the short term, are negative as well. And then, of course, just in terms of the U.S. Federal Reserve, talking about how they'll let inflation move higher than 2%. Inflation often is like the genie out of the bottle. Once it gets out, it's hard to put back in. Lastly, we are seeing inflationary pressure just from genuine supply considerations. A lot of supply chains are being remapped, and globalizations arguably has plateaued, at least for the time being. All of that could create inflationary pressures. And quite frankly, we are seeing this in a lot of the market and economic data already. The dollar is weaker, has been weaker of late. We've also seen commodities move higher. We've seen gold prices move higher. We've seen cryptocurrencies move higher. All of them are hedges versus inflation. And then in terms of economic data, quite frankly, inflation and inflation expectations have also moved higher as well. I think the third thing to keep in mind is, and probably the most important, because again, regardless of who wins the election, the most important thing I think for an investment advisor is to articulate and have confidence in their investment philosophy. Again, I believe a confident advisor makes confident investors. And again, the investment philosophy that they can believe in through thick and thin, through strong and weak times for both the markets and the economy is crucial. That's what I believe in. First of all, to build wealth, you have to invest. And I think that I'm thankful that the stock market is there to allow us to participate in global growth and global innovation. And it's really remarkable to think about that the stock market has a positive return about 2/3 of the time on a rolling 12-month basis. That percentage only goes up over time. You just think about it on a one-year time frame, still 2 out of 3 times is higher. And that's despite the fact sometimes the market is overvalued. Sometimes it's had an incredible run prior to that. And then sometimes you've had presidential elections and the market still generates a positive return. The second thing, of course, is to diversify portfolios. I think diversified portfolios are humble. They're also resilient. And I think it's important to diversify not just by asset class and by region, but also by investment strategy. Different strategies do better in different environments. And the third thing, of course, is to reach one's goals, you have to stay invested. And again, you have to have a plan and you have to execute on that plan. That requires patience, that requires discipline. And of course, sometimes for many investors, it flat out requires advice. So in sum, what do I think investors should do is first, invest. And again, the market has a positive expectation moving forward. And secondly, I think investors need to diversify. And I think that having exposure in this environment to either active or tactical strategies makes sense. There are areas of the global markets where relative valuations are significantly more attractive than some of the leading stocks in the U.S. This does include international stocks. This includes value-oriented stocks. This includes small-cap stocks. Lastly, diversify. Again, diversify to the appropriate level of overall portfolio risk within the portfolios. Fixed income still deserves a role, particularly high quality fixed income. It's still the best hedge versus stock market weakness, but also given anticipated inflation expectations and inflation moving higher, also real assets and other alternative strategies. Well, thank you for your time. Stay balanced and be well.